Imagine a stock so powerful that the biggest funds on Wall Street were forced to buy millions of dollars of it. You'd think the price would skyrocket, right? Well, yesterday SpaceX, trading under the ticker SPCX, officially joined the prestigious Nasdaq 100 index. It was supposed to be a historic victory lap. Instead, the stock crashed nearly 7%, plunging into a post-IPO low of around $147 a share. If you're a new investor, this makes absolutely no sense. SpaceX is dominating the space race, yet its stock is now down over 30% from its June peak of $225. So what happened? You just witnessed a classic Wall Street trap called a sell the news event. See, index funds like the massive Invesco QQQ Trust track the Nasdaq 100. When a new powerhouse like SpaceX gets added, those funds have to buy it, no matter the price. Wall Street insiders knew this multi-billion-dollar wave of forced buying was coming on July 7th. So what did they do? They used that massive buying power as an exit door, dumping their shares onto the market to lock in massive profits. The insiders walked away with cash, while everyday investors were left holding the bag. Now that SpaceX's official post-IPO quiet period is over, Wall Street's biggest banks are finally allowed to tell us what they think this company's actually worth. And right now the experts are arguing about it. On one side you have the mega bulls. Morgan Stanley just initiated coverage on a massive $300 price target. They aren't looking at SpaceX as just a rocket company, they see it as the ultimate backbone for artificial intelligence. But their prediction comes with a mind-blowing catch. Morgan Stanley warns that to build Elon's dream of space-based AI data centers, SpaceX is going to have to borrow an eye-watering $700 billion in debt. That's a massive red flag to watch. High debt can crush a company if interest rates stay high. On the other side, the bears are screaming warnings. Research firm MoffettNathanson slapped SpaceX with a sell rating and a $131 price target. They called the company's multi-trillion-dollar valuation models absurd, warning that the hype around space intelligence is wildly decoupled from reality. But if you want to know why people are willing to risk their money on Elon Musk, you only have to look at two massive pieces of news that dropped this week. First, Starlink just proved it has a terrifying amount of pricing power. They abruptly doubled the price of their global satellite internet for business airplanes, hiking it from $10,000 a month to a staggering $20,000 a month. When a company can double its prices overnight and its customers just have to pay it, that means they have a functional monopoly. Second, SpaceX just filed official paperwork with the FCC to launch 100,000 next-generation Starlink satellites into space. To put that into perspective, there are only about 10,000 active satellites orbiting Earth right now total. SpaceX wants to multiply that by 10 using their massive new Starship rocket. So is SpaceX a buy at $150 a share? High-profile investors like Cathie and her ARK Innovation ETF think so. They've been aggressively buying up tens of thousands of shares during this dip. But the clock is ticking. Jeff Bezos' rival space company Blue Origin just announced it's raising $10 billion in its first ever outside funding round. The billionaire space wars are getting heavily capitalized and SpaceX is finally getting some real competition. If you're a new investor, the lesson here is simple. Great companies don't always make for stable stocks right after an IPO. Watch the $135 initial IPO price line. If SpaceX falls below that, the panic may just begin. If you want more straight and to the point news like this, give it a like, subscribe, and I'll see you in the next one.